Okay guys, welcome to another video. We're going to talk about building wealth, building passive income through dividend investing. So we're going to get into all kinds of specifics about what dividends are, how they work, why it's a good strategy, and what it means for you over time as you really build wealth through that consistent stream of passive income.
You have to pay attention to your money.
Okay, first up, let's talk about the basics of what dividends are. So typically when a company is young, it is all about growth, right? So companies are looking to capture additional market share. They're taking all of the profits and they're pouring them back into their business so they can grow faster and faster. Eventually, those companies will reach a point where they are actually taking in more money than they can actually use to fuel additional growth, right? As companies become bigger, it's actually harder to grow. It's harder to reinvest in the business and capture more market share. When a company reaches this point, it has a responsibility to distribute that additional cash out to its shareholders. And literally, this is just a cash payment that gets paid out to the shareholders on a quarterly or a monthly basis, and the cash just lands in your account. It's the ultimate form of passive income. You can just watch that money roll in over time. One of the things I love about dividend investing as a strategy too is that these dividend payments are taxed at very favorable rates, both in Canada and in the US. There are tax credits associated with them or reduced tax rates that make them ideal if you have to invest money in a taxable account. Now, if you have money that is sheltered in some kind of tax sheltered account, a TFSA, an RRSP, an IRA if you're in the US, whatever it is, then that's a bit less of an advantage. But when your portfolio grows beyond the limits of what you can shelter and you're forced to invest in taxable accounts, dividends can be a really cool way to minimize your tax bill. The other thing to consider about dividends is that they are unaffected by the volatility of changes in a stock's price. So the price can go up or down constantly from day to day. The dividend payment is not affected by that, right? You're going to get the same amount of money at the end of the quarter or at the end of the month. Now, that's not to say dividends can't change. They can absolutely be cut, they can be eliminated entirely, or they can grow over time. So the latter is the most likely thing that's going to happen. As a company continues to be profitable, it's going to continue to take in excess cash, and it is probably going to increase that dividend payout over time. That's mostly what happens to these companies. Now, if a company gets into trouble, if it loses a chunk of business, maybe there's some unfavorable change that happens, or maybe the economy just tanks and they're hit particularly hard. We saw this in March, April timeframe of 2020, where a lot of businesses were hit really hard by the loss of business, and they immediately suspended their dividends and in some cases cut them almost permanently on a go-forward basis because their business has changed drastically. So this is a risk that you need to be on the lookout for. And depending on your risk tolerance as a dividend investor, you want to select companies that have the least likelihood of cutting that dividend. So let's talk about dividend investing as a strategy. Basically, the idea is that you are really focused on that cash payout from the stock. How much is it? How frequently does it get paid? And how likely is it to grow or be cut in the future? This is kind of where your analysis really focuses in when you're a dividend investor. Now, typically people will often say that one of the great things about dividends is that you can reinvest them in the stock. And people will often talk about the advantages of these programs called DRIPs, or dividend reinvestment programs. Personally, I think these things are overrated. Basically, if you enroll in a DRIP, it will take the dividend payment that you otherwise would have gotten, and it will be used to buy additional shares of the stock, sometimes at a discount, which is nice, and then you get those shares in your account. So it's a form of autopilot investing, right? Instead of getting the cash, you simply have your holding grow automatically in that company over time. The reason I think it's overrated, and the reason I never do it, is that I don't necessarily know if that's the best place for my money. Typically I own, say, 18 to 20 stocks at a particular time, and when I get cash from one stock, maybe it would actually be better if I bought a totally different stock with that cash payment, or increased my holdings in a different stock. So I don't think there's any good reason to restrict my reinvestment to that particular stock that paid the dividend. Now, yes, In those cases where there's a significant discount offered on the DRIP program, there can be a good argument for it, but those are becoming more rare over time. But really, the single big advantage, and this is the reason that most people are investing in dividend-paying stocks, is that you want to get to this point where the income stream from your dividends is enough to live off of, and you can then retire. Now, if this is your strategy for retirement, what it means is that when you stop working, you are going to simply take those dividends out of your account and live on them, but you are not going to touch the principal that's invested in that stock, for the most part. The reason is that if you start eating away at the principal, your dividend payment is going to go down because you own fewer shares to pay dividends. So I really love this approach. I think that investing in dividends this way to build up this passive income stream gives you a margin of safety. And what I mean by that is that you have that dividend income stream that's paying you all of that money. But if you need more than that, you also have that principal that you haven't touched, that in an emergency, maybe later on in your retirement years, you can then make the decision to start withdrawing that capital as well. I think, if you compare this to the typical approach of non-dividend paying stocks, if you're just looking at capital growth in your portfolio, then there's an element of danger there, because if you don't have enough money in your retirement account at the point you retire, and if you withdraw that money too quickly, you may run out of money and be completely broke in your old age when you actually need some of that cash. It's a difficult calculation to make in terms of what is the safe amount that you can withdraw. Compared to the dividend approach, where you know pretty much exactly what that income stream is going to be. You can predict it, you have a pretty good assurance that it's going to stay the same, and you can actually plan against the income that you're going to have down the road. So I mentioned taxes a little bit earlier, and I think it's worth bringing it up again. I think that if you're in the position of investing in a taxable account, you really have to look hard at dividend investing as a strategy. In Canada, we have something called the eligible dividend tax credit. And unbelievable as it is, in Canada, you can actually make, I think it's in excess of $50,000, depending on which province you live in, and pay zero income tax if all of that income came from eligible dividends. And similarly, in the US, if you invest in companies that pay qualified dividends, and if you follow the rules associated with those qualified dividends, and if your income is below a certain threshold, then you're going to pay very little tax on that dividend income. So I want to say a little bit about the difference between investing for dividends as a strategy and investing in growth stocks as a strategy. So many people will say that it shouldn't matter even a little bit whether the total return comes from a combination of dividends and growth, or just growth, or just dividends. So on the surface and math-wise, that is absolutely correct. I totally agree with it. In practice, though, the difference is huge. When you are dealing with nothing but a pure growth portfolio that doesn't have the stability of dividend income, you are much more likely to make bad buy and sell decisions based on price action and the volatility of day-to-day price changes in those stocks. If your strategy, on the other hand, is based on dividend income, though, a lot of that volatility drops away, because you know that though that day-to-day volatility in stock price movement doesn't affect your income stream. Now, sure, it can be pretty devastating if a company that you hold suddenly cuts or suspends their dividend unexpectedly. The stock price also drops as a result of that, and your income stream takes a hit. That absolutely will happen, but it is far less frequent and far less volatile than some massive drawdown that you might experience in a pure growth portfolio. There's another head-to-head comparison that you can make in terms of yield versus growth. And I'm not talking about growth in terms of the price of a stock, I'm actually talking about growth in the dividend. And so we look for a healthy yield, typically, say in the 2, 3, 5% range, something like this. If we see a really high yield, say above 6%, you can see some super high yields bordering on 7, 8, 9%. The prospect for that dividend payment to increase in the future is not high. If they're already paying out a ton of money, it's less likely that they're going to be able to increase that payout next year. You may not get a raise next year, basically. On the other hand, stocks that have a very low, small, conservative dividend, are a little bit less likely then to be able to increase that dividend in the future. So I think here you have to consider your own investing time horizon. Are you early on in building that portfolio? If you are, then I think you want to look at these lower yield but higher growth stocks. If you're closer to retirement, or if you're already there, then I think you're going to want immediate cash. So you're looking at high yield, but maybe lower growth potential in these stocks. So be aware of where you are in your time horizon and understand that there are different types of dividend stocks on the growth side or on the yield side, and make sure you're picking the ones that fit your goals. Okay guys, that's it. I hope this is helpful. I hope this helps you all get started in building your own dividend growth portfolio, get you on that road to early retirement. I'm about 2 years away and I'm excited about it. So please, if you like this video, if you want some more, hit the subscribe button, give it a like, ring the bell so you get notified, and I'll see you on the next one.